There's a fear that quietly costs ordinary investors more money than any market crash ever has. It isn't losing money in a downturn. It's waiting, sitting in cash, telling yourself you'll invest once things feel safe. And here's the uncomfortable part. The very moments that feel most dangerous are often the ones that build the most wealth. The crash you're afraid of usually does less damage than the waiting you do to avoid it. This isn't financial advice. It's about understanding why trying to time the market backfires and what history actually shows. So let's start with what timing the market really means. It means trying to buy right before things go up and sell right before they go down. On paper, it sounds like the smartest possible strategy. In practice, it quietly asks you to be right twice. You have to guess when to get out, and then guess again when to get back in. And the timing rarely feels the way you expect. Markets often fall when the news is calm and rise when the headlines are terrifying. By the time it feels safe to invest again, the recovery has usually already happened, and you paid to sit it out. So the person waiting for certainty is really waiting for a signal that, historically, never arrives on time. Certainty and low prices almost never show up together. Quick pause, because this next part matters. And if this is already making the fear feel a little smaller, don't forget to subscribe and give a thumbs up. It genuinely helps the channel, and it means more people who feel stuck on the sidelines get to see this. Here's the piece almost nobody sees coming. Historically, a huge share of the market's total gains have arrived in a tiny number of very good days. And those best days tend to cluster right next to the worst ones, often in the middle of the scariest stretches. Illustratively, studies of long historical periods have found that an investor who stayed fully invested ended up dramatically ahead of one who missed just the 10 or 20 best days over decades. Not the best years, the best days. Miss a small handful, and a large chunk of your lifetime return can quietly disappear. And here's the trap that closes the loop. The only way to miss those best days is to be sitting in cash during the fear, which is exactly where market timing tends to put you. The strategy designed to avoid the worst days almost guarantees you also miss the best ones. So why do smart, careful people keep doing this? Because our brains were never built for investing. They were built to survive. We feel the pain of a loss far more sharply than the pleasure of an equal gain. So when the market drops, the instinct isn't to calmly hold. It's to make the pain stop by selling. And when everything is soaring and everyone's euphoric, the instinct is to pile in at the top. Feel good buying high, feel bad selling low. The exact opposite of what builds wealth. None of this means you're foolish. It means you're human. The investors who do well aren't the ones with no fear. They're the ones who build a system so their fear doesn't get to make the decisions. So what actually works? Not prediction, participation. The most reliable approach history has shown is almost embarrassingly simple. Invest steadily, on a schedule, and let time do the heavy lifting. This is often called investing a fixed amount at regular intervals, automatically, no matter what the market is doing. When prices are high, your money buys a little less. When prices are low, the same money buys more. You stop trying to guess the perfect moment because you're buying at every moment. And here's the quiet reframe that changes everything. A crash isn't the enemy of a steady investor. For someone still buying, lower prices are a discount. The downturn that terrifies the market timer is the same downturn that loads up the automatic investor at cheaper prices. Pair that with owning something broad and low-cost, like a whole market index fund, and you've replaced a lifetime of stressful guessing with a system that runs on autopilot and time. So here's the reframe to carry with you. The real risk for most ordinary investors was never the crash. Markets have recovered from every one of them so far. The real risk is missing the recovery because you were on the sidelines waiting for a safety that never announces itself. You will never catch the perfect moment. The good news is you don't have to. Time in the market has historically beaten timing the market, not because it's clever, but because it stops you from being your own worst enemy. This is education, not advice. Markets carry real risk. Past performance doesn't guarantee the future, and your situation is your own. For that, a licensed professional is worth it. If this made the fear feel a little smaller, don't forget to subscribe and give a thumbs up. Every week we break down how money actually works. No hype. The free net worth tracker in the description helps you watch the slow, steady progress that timing can never give you. Before you go, tell me in the comments, what's one investment you've been putting off starting? And what's the fear that's been holding you back? I read every reply. I'll see you in the next one.